Hello, my name is Maria Besubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is September 2nd, 2024, and it is a weekly markets update. Let's have a look at the news of week 35 and see what are the next trends. Urea market was on hold, waiting for the results of the Indian tender that closed on August 29. Price bids are expected to be revealed today. However, first rumors indicate that lowest bids for CFR West Coast were put at $338 and for CFR East Coast at $345. Tender participation was very active, with 24 trading companies submitted their proposals. The anticipated volume is the same as discussed before, from 800,000 tons to 1 million tons. Offtake product from various Middle East producers is expected in the tender, as well as massive supply of material from the Baltics. China is not expected to take part directly, but several cargoes of free exported Iranian product might materialize. Expected CFR level indicates FOB level for Middle East producers around $320 and Russian producers shipping from Baltics at around $280 FOB. These levels are at least $10 lower versus latest sales into Latin America, for example, so clearly producers will not be happy. But lack of sales for September shipment, stocks building up slowly, will support bearish tendency, despite previous unwillingness to sell at lower levels. Despite lack of clarity regarding tender results in terms of volume, first of all, and thus future price trend, the market is cautiously optimistic about Q4. Indian demand is solid due to very good monsoon. Also, some demand emerges in Africa and Americas. Another precious tender from Ethiopia for about 250,000 tons is expected soon. So, after a price drop for the tender, there might be an uptick later in September and October. Last week, Egyptian producers were testing new lower price levels and sold 23,000 tons of granular urea in total at $345 FOB and another 5,000 at $340. In order to fill the books for September, for the Northern African producers, Europe needs to come back to the market for refill purchases. However, for now there are no signs of such demand yet. In China, despite domestic prices deterioration, sources indicate that exports will be halted for the rest of the year. And Q1 and 2 usually are low in terms of exports anyways, due to domestic consumption season. So, if this is true, we might see no Chinese volumes in the international market for almost one more year. Several sales tenders emerged in Iran, however, with no sales confirmed. Parties offered 50,000 tons of granular, targeting $300 FOB. MIS offered 30,000 tons, and Shiraz closed tender for 25,000 tons of pearled, with target of $320 FOB. None of those resulted in sales, as per market info. Also, SOCAR held a tender for 30,000 tons of granular in bulk from Poti and 20,000 in big bags from Trabzon. We will have more info about the results this week. In Brazil, buyers stepped back from the market looking for lower CFR price rather than 350 level that circulated in the past weeks. Importers and distributors continue to be cautious due to poor barter ratios. In Argentina, there will be a drop in the tax applied to foreign currency exchange transaction for imports as of today, from 17.5% to 7.5%. This should bring an uptick in the demand. In the US, demand was almost non-existing and values dropped more amid softening crops prices. Now the difference between US CFR and Brazil CFR reached $10. So US this year attracts much lower imports volumes than historically. Paper values again corrected downward. They don't support the idea of market analysts that prices pick up later in the year after demand from India will be balanced with current excess supply, at least yet, before tender results announced. Egypt FOB values lost $5. September, October and November average is $335 FOB. NOLA FOB values lost $6 for September to the level of average $304, while for October and November lost $3 to average 300 FOB. Arab Gulf FOB values declined by $5 to the level of $325 for 3 months ahead. Brazil CFR also lost $5 and reached average $340 for September and $335 for October and November. Ammonium sulfate market prices remained mostly stable across the regions, with demand limited even in Brazil. Chinese standard grade prices slightly firmed to 140-45 FOB amid anticipation of demand from compactors for shipment to Brazil in upcoming weeks. Compacted and granular product prices remained at the level of $160 to $65 FOB. Indian importer closed a tender for 25,000 tons of standard product for shipment before the 10th of October. Proposals were heard at the level of $170 to $75 CFR, however, no deal was confirmed yet. In Central America, Incofe closed a tender for purchase of 16,000 to 18,000 tons of standard UMSO, plus up to 7,000 tons of granular product, with an option also for some amount of NPs in the same vessel, with shipment to 3 ports. Award will follow this week. We will learn the details then. There was no activity in nitrates or UAN markets last week. Only in South America, limited purchasing activity is happening. Fresh proposals for AN to CFR Brazil from Baltics increased to the level of $285. Ammonia market was driven by 2 major news last week. First, new price of Yara and Mosaic for September was settled at $530 CFR, which means $55 hike from previous month price. It supported the bullish sentiment that we discussed last week, and even surpassed it. In fact, this price places the contract in line with the last done business to Europe from North Africa. And taking into account previous hike of $60 between July and August price, the US benchmark returns to more or less January level. At the same time, supply west of Suez continues to improve. Trinidad operating rates increased to usual 70–80%. Also, supply from Algeria and Egypt is quite stable. Second news comes from the East and will support prices that were under pressure during past weeks there. Ma'aden, 1.1 million tons plant, is expected to shut down mid-September for a month due to technical issue. This might take out from the market about 90,000 tons of product and likely result in shipment delays for current buyers, because Ma'aden was sold out until mid-October. In India, demand continues to be supported by low DAP stocks, and domestic DAP production based on imported ammonia still is more financially viable option than imports of finished material. With squeezing supply options, fresh proposals for India will be likely above $400 CFR. Dynamics in phosphate segment after the deal concluded by OCP to India has slowed down. In the West from Suez, there was almost no activity. Neither Brazil nor Argentina purchased any fresh volumes. Price indications remained unchanged. In the US, distributors are anticipating limited demand in the fall due to decreasing phosphates affordability amid softening crops prices. Also, this will compound with limited import options, so market expects application rates drop. In Egypt, NCIC producers sold the full lot of 30,000 tons for its September tender at $610 to $12 FOB, which is a $5 drop from the previous price level. The whole volume will head to several buyers in Europe. In Ethiopia, Ethiopian agricultural businesses issued a tender to buy 360,000 tons of DAP that will close on September 9. It is expected that EABC will issue further DAP tenders instead of NPS that was usually purchased before. Previously, it was OCP closing all tenders, but this time, huge volume significantly increased, and other players might be interested to participate as well. In the east of Suez, India importers likely are in discussions with Saudi producer for purchasing of DAP at plus $15 to $20 to the level of $620 deal with OCP. There were several more deals done last week in India, and also tenders announced. 55,000 tons of Chinese DAP for prompt shipment was purchased at $620 CFR, a cargo that was cleared before the ban on Chinese exports took place. Also, 30,000 tons of Russian DAP was sold at the same price for mid-October shipment. 2 tenders for total purchase of 100,000 tons were issued by RCF and HURL, closing next week. Bangladesh government received offers for its DAP tender closed on August 25, totaling 244,000 tons from 7 suppliers. Prices are in the range between $690 to $716 CFR for 40,000 tons. The product is expected to come from China. Prices in China were stable at the level of $605 to $10 FOB. Market sources indicate that customs inspections for DAP and MAP cargoes could be extended to up to 40 days, or possibly 28 days, up from the current 14-day period. But this news is not officially confirmed. In Pakistan, offers heard at around $630 to $40 CFR, with heavy rains dampening demand, and the country perhaps is done with most of the imports for the season. In the potash segment, the news of the week was Indian IPL signing a new standard MOP contract with Israeli ICL for supply of around 420,000 tons of product until end of this year. Price details remain undisclosed, but it is understood to be within current price level in India. With this contract, ICL is sold out for the full of 2024. Some market news. Koch Energy has successfully completed its acquisition of OCI fertilizer plant in Weaver, Iowa, for $3.6 billion. This acquisition was first announced in December 2023 and gives Koch ownership of the facility and associated businesses. Moving to the fundamentals. European natural gas futures climbed again almost to the level of 40 euros per megawatt hour amid concerns about Norwegian gas supply. Last week, maintenance has reduced Norwegian gas nominations by 10 million cubic meters per day, affecting major pipelines. However, in general, Europe is well prepared for winter with 92% of storages full, so hopefully this is just a short price move. US natural gas futures slightly increased versus a week ago to the level of $2.12 per MMBtu. On August 29, US Energy Information Administration released its weekly natural gas storage report. The report indicated gas in storage increased by 35 billion cubic meters, lower than analyst consensus of 38 billion. Thus, this provoked small price correction upwards. However, from a big picture point of view, oversupply remains a key problem for natural gas markets. Agricultural commodities futures prices rebounded this week. Looks like the funds are continuing to get out of their short positions. Wheat futures climbed by more than 5% to $5.32 per bushel. For the week ending August 22, net sales of 532,000 tons of wheat were reported for delivery in the year 24-25, exceeding expectations. Also, supply constraints from other exports regions globally influenced the trend, even despite the availability of cheaper wheat from the Black Sea region. Quality data from France indicated that only 26% of the French wheat crop met test weight standards after rains impacted crop production and quality. After hitting the lowest level in 4 years a week ago, corn futures climbed above $4 per bushel again. Weekly new crop exports were very strong, and so was the weekly ethanol production, which supported prices rebounding. However, sluggish demand from China, which has significantly decreased its imports compared to previous years amid economic uncertainties and changing policies, further exacerbates the downward pressure on prices. And despite record ethanol production rates, the projected increase in ending stocks, expected to exceed 600 million bushels, indicates a challenging landscape for corn prices in the future. Soybean futures increased by 3% to the level of $9.8 per bushel. It is driven by supply concerns as adverse weather in the US Midwest raised fears of reduced yields. The recent hot and dry conditions have heightened worries about the potential impact on the anticipated bumper corn and soybean harvests. This heatwave has bolstered prices in recent sessions, as it threatens to damage the soybean during a crucial stage of its development. While recent rainfall has alleviated dryness in some areas, uncertainty remains about whether it will be enough to allow the soybean crop to reach its full potential. Moving to the shipping industry. Containerized freight index lost another 5% and dropped to the level of lower than 3,000 points. Upward price rally started back in May after the decision of the US administration to impose additional import tariffs on the selected number of goods from China. And now, in coming days, it is expected that the administration will unveil its final implementation plans for tariffs increase. On top of that, last week, Canada, following the US regulation, announced similar import tariffs increase for the selected number of goods from China. So, after cooling down of emerged demand for containers from May and onwards, there might be another uptick due to the recent news. Not that sharp though. The Baltic Exchange Dry Index increased by 50 points or more than 2% during past week. It was mainly supported by strong results in Capesize segment, while Panamax segment demonstrated slow activity and further losses in terms of index. In Ultramax segment, the market has seen a mixed affair. There was increased activity from the US Gulf and rates had pushed up slightly, but options for owners with vessels open from the South Atlantic remained rather limited. For the handysize sector, it was a quiet week, with activity remaining slow across the continent and the Mediterranean, with sentiment appearing position. The strike at Canadian railways that shocked the market on August 22 was not long-living. After 4 days and government intervening, it was over. The parties entered binding arbitration that will solve the problem. Otherwise, longer stoppage would have echoed across North American supply chains for virtually all commodities, including fertilizers, potash first of all, and grains. But now the effect seems to be minimal, and hopefully the dispute will be finally resolved soon. To sum up, the sentiment in urea market after first results of Indian tender continues to be bearish. The most important that the whole market is waiting is to see final volume that will be locked in the tender. The stocks at producers' warehouses start to pile up, so the market needs badly that India confirms close to 1 million tons purchase. Ammonia price in the September deal between Yara and Mosaic hiked by $55, supporting bullish sentiment, which, on top of that, is building up east of Suez, with Ma'aden plant out for a month due to a technical issue. Phosphate market remains more or less stable after OCP deal last week. Indian importers announced several more tenders for prompt shipments, but also there is robust demand for imported ammonia for domestic production of DAP, which provides better margins compared to imports of finished product. Agricultural commodities futures picked up after historical lows of a week ago. This is a result of both funds continuing to get out of their short positions, as well as certain fundamental reasons like hot weather in the US menacing quality and quantity of soybean harvest. European gas price increased again amid concerns about Norwegian gas supply, hopefully short-lasting. Canadian rail strike stopped after 4 days without significant impact at supply chains. Containerized index continues losing points, however, might see the reverse amid announcement of Canadian government to imply similar steps in import tariff increase for Chinese goods that US did back in May. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon!